tourism in Las Vegas is in a big slump this summer, costing the city billions of dollars. Some are saying that could signal trouble ahead for the U.S. economy.
Vegas may still dazzle, but for many visitors, that sparkle now comes at a steeper price, from soaring hotel rates to $9 coffees. Inflation is hitting hard, and fewer tourists are traveling to the famous destination.
Of hotel incentives, every single tourist I spoke to complained about high costs.
Vegas looked unstoppable until the cracks showed. In 2023, MGM systems were knocked offline by a cyber attack that cost about $100 million and exposed how fragile Strip operations can be. Fast forward to late 2025. Visitor counts, occupancy, and RevPAR have cooled, and rate growth has faded. Right as the cycle turns, Wynn is leaning into its biggest expansion ever, with roughly $10.5 billion of debt on the balance sheet and a splashy new resort planned in the United Arab Emirates. The headline promise was scale and prestige. The near-term result is strain. First, clarity on the phrase MGM's collapse. It wasn't a bankruptcy. It was a cascade. The September 2023 cyber attack that shut down check-in systems, loyalty apps, and even some slot payouts, followed by a softer 2025 for Las Vegas results that shook investor confidence across the Strip. The attack alone carried an estimated 9-figure cost. Then the macro picture cooled. In September 2025, Las Vegas visitor volume fell year over year, hotel occupancy slipped to the high 70s, and average rates stopped climbing. On the Strip, revenue per available room, RevPAR, which combines occupancy with average daily rate, declined. None of this means Vegas is broken. It means the post-pandemic surge has normalized, the events calendar isn't doing all the heavy lifting, and operators must manage through a slower patch. That backdrop matters because Wynn, a company known for high-touch luxury and large capital projects, is in the middle of a two-front bet: a brand-new resort in the UAE and growth ambitions beyond its home markets. Meanwhile, competitors are tightening costs and pacing capital spending, betting that the next upcycle will reward flexibility more than fixed commitments. Here's the thesis. Wynn's ambitious spend is colliding with a cooler Vegas cycle and rising project costs. The company is carrying roughly $10.5 billion of debt while advancing a resort on an artificial island in the United Arab Emirates, with a target opening in early 2027. At the same time, Wynn pulled its high-profile New York casino bid after local resistance and political headwinds. Taken together, the timing makes the strategy look like it's backfiring, at least for now, by stretching balance sheet flexibility and raising execution risk just as Strip demand eases. Longer term, Macau and the UAE could still pay off, but today's numbers force harder trade-offs. But what are the numbers? Let's dive in. The debt load is about $10.5 billion in total as of mid-2025. Cash and equivalents, just over $2.0 billion heading into mid-2025. The UAE project, Wynn Al Marjan Island budget, is now around $5.1 billion. The financing includes a $2.4 billion construction facility that closed in early 2025. A $5.5 million Nevada fine in the beginning of 2025. Small in dollars, notable as a reminder of regulatory risk. Consider the New York pivot. Wynn partnered with, related to pitch a roughly $12 billion integrated resort at Hudson Yards, on Manhattan's west side. The plan evolved to include a major housing component, eventually marketed at about 4,000 units, in an effort to answer community and political concerns. It was the flagship of Wynn's push to plant a flag in the nation's biggest media market, where 3 downstate casino licenses were set to be awarded. But downstate licensing has been shaped as much by neighborhood politics as by economics. Community board opposition hardened, and elected officials remained non-committal. By May 2025, the message was clear: support wasn't there. Around the 20th of May, Wynn and Related withdrew the bid, pivoting focus to housing on the site while keeping options open for gaming elsewhere. Why this matters to the thesis? The New York exit removes a potential future earnings stream that could have balanced Vegas cyclicality and UAE execution risk. It also underscores how long-dated, high-capex casino projects are at the mercy of local process, zoning, traffic, affordable housing, labor, and political timing. Investors still get upside from Macau and eventually the UAE, but the U.S. expansion leg is now lighter than planned. There is a counterpoint. Walking away early saved years of holding costs and political drag, and freed management bandwidth for projects with clearer line of sight. Still, in narrative terms, the retreat reads as a backfire relative to the headline promise of multi-city growth. If you zoom in on the numbers, New York's path to a license was always crowded, multiple billion-dollar proposals chasing only 3 awards. Even a winning bid would likely have faced a long build, cost escalation, union negotiations, and potential litigation. Exiting now may compress near-term disappointment into a single quarter, instead of dragging it out over years. The New York chapter shows how growth stories can hinge on politics as much as spreadsheets. If you're finding this breakdown useful, tap like and subscribe to our channel for clear-sourced business explainers. It helps more people see the story, and it tells us you want deeper dives on companies like Wynn, MGM, and the operators shaping the Strip's next chapter. Got a question about a number we cited? Drop it in the comments. We'll pin the most helpful clarifications in the description. And if you've got data we should analyze next, tag us, and we'll put it on the list. With Vegas cooling and New York off the board, the carrying cost of growth looms larger. Construction budgets have risen with materials and labor inflation, and interest expense stays sticky while rates remain elevated. Every month closer to opening day in the UAE, cash is burned on design, site work, and pre-opening teams, while near-term Strip metrics are softer. For hotel casino operators, the math is simple. When occupancy dips and rate growth stalls, RevPAR falls. When RevPAR falls, flow-through to profit compresses. Layer in higher borrowing costs, and returns on new projects must clear a higher hurdle. There are buffers. Wynn's Macau properties continue to benefit from steady recovery in international travel and premium mass play, and quarterly results often hinge on hold volatility, the percentage of wagers the house keeps. A few lucky or unlucky weeks can swing margins. Also, the Las Vegas calendar can surprise on the upside. A blockbuster convention, a big fight week, or a strong New Year's can change quarterly narratives. But structural pressures, more supply coming online, costlier financing, and an events calendar that can't be record-breaking every month suggest investors should expect choppier results while the UAE build soaks up capital. On the expense line, utilities, insurance, and wages remain higher than pre-pandemic trends, limiting how much cost can be flexed without impacting service. And while technology helps with staffing, cyber and compliance budgets have permanently stepped up since 2023's wake-up call. For guests, that can mean fewer freebies and more dynamic pricing. For investors, it means patience while projects mature. For lenders and landlords, watch covenants and rent escalators. For equity holders, expect guidance to emphasize liquidity buffers and staged openings. None of this is catastrophic, but it narrows the margin for error until a new demand upswing arrives. Vegas has cycled before. After the Great Recession, visitation and room pricing took years to rebuild. More recently, the post-pandemic rush brought record weekends and eye-popping rates, helped by a stacked events slate. That surge set a high bar. When the calendar normalizes, fewer mega events in a given month, occupancy and pricing step down, even if the long-term trend remains healthy. The lesson: Strip performance isn't linear. It rises and falls with airfare costs, international arrivals, convention timing, and disposable income. Wynn's strategy sits on top of that rhythm. The company is trying to sprint during a stretch of headwinds. History doesn't repeat exactly, but it rhymes. Expansions launched into soft patches often look ill-timed at first, then pay off years later if the assets are truly differentiated. What comes next? The biggest swing factor is the UAE. If Wynn Al Marjan Island opens on time in early 2027 with a full gaming license, the property could enjoy a first-mover advantage in the Gulf, capturing high-end regional demand that currently flies to Europe or Asia. That upside isn't guaranteed. The regulatory framework is new and untested at scale, and timelines can slip on large, complex builds, especially on artificial islands. Investors should watch 3 things: progress milestones from contractors, financing updates as rates evolve, and early hiring marketing signals that point to opening momentum. Meanwhile, Macau can continue to offset Las Vegas softness if premium mass trends hold, while the Strip's fortunes will track airfare, convention bookings, and event calendars. If the data stabilizes, visitor volume, occupancy back into the low 80s, and RevPAR flat to slightly up, Wynn's balance sheet pressure eases. If not, expect sharper focus on capex pacing, cost discipline, and optionality around non-core projects. Add in geopolitical and travel visa variables, especially for the Gulf and China, and scenario planning matters. Graphic: timeline with milestones through 2027. Financing, topping out, pre-opening, soft open, full launch. Management credibility will hinge on hitting those waypoints, communicating transparently, and proving that premium demand materializes at sustainable margins. Zooming out, is Wynn's UAE push a bold first-mover edge, or an expensive distraction in a down cycle? Do you expect the Strip to stabilize as airline capacity improves and conventions reset? Or do you see more room for rates to fall in 2026? Tell us what you're seeing on the ground: room prices, midweek foot traffic, or conference budgets. If you found this helpful, subscribe to our channel and share it with someone following the gaming sector. What should we break down next? Macau recovery scenarios, the UAE regulatory playbook, or how event calendars move ADR by week. We read every comment, and your on-the-ground notes help us separate narrative from numbers. Thanks for watching.